Featured guest is Jim Moffett, fund manager at Scout Investment Advisors. And Jim, I do want to start with you. So my understanding is you see no reason not to be optimistic here in terms of the outlook for stocks.
Right. We're same place Bob Dole is, essentially where we think the money spigots have been turned on. The economy's turning around slowly. We don't think it's going to be a great recovery, but we think that markets are going to be very, very good to us for the next 3 to 6 months.
Hey, Jim, you think stocks are under-owned here? Is that a reference to the retail investor? Do you think the retail investor still needs to get back into the market?
No, I think the retailer, but I think there are a lot of advisors out there that are also under-owned in stocks that they've been cautious and they've been slow getting back. One of our guys was making a trip marketing to the advisors, and he found that a lot of them were still had a lot of cash on the books.
What are they waiting for, Jim?
I don't know personally. I wasn't part of that conversation, but that's.
Well, but what do you think they're waiting for? I mean, we've heard a lot of people come on and say there's still tons and tons of cash on the sidelines. We know a lot of investors are putting money into bond funds. They're not putting into equity funds. What is it going to take for all that cash on the sideline, all that cash in bond funds, to come back into the equity market?
Well, I think some of it is they're waiting for a pullback, and you know, they say the market doesn't give a sucker a break. Well, they keep looking for that break, and it just doesn't happen. At some point, are they going to have to capitulate? I don't know.
Is there, I mean, do you think that allocations will be different now? Is everything going to be different as far as ownership? I mean, there has been that argument that baby boomers and a lot of people got burned so many times by equities that they just aren't going to come back in.
Oh, I think there's some of that. I think that the bond guys, the fixed income guys, that's a good place to put some money. A lot of people that were, you know, basically almost all equities, they need another place. They need more balance in their portfolio. They're getting to retirement age or close to it, and I think people just realize that, you know, they can't stomach the risk that they thought they could.
You know, Jim, we know employment, it's a lagging indicator, but I'm just wondering, you said, you know, maybe folks are waiting for some different things. I mean, are they waiting to see some signs of life in the jobs market?
That's possible. I don't know what's holding them back, but that's part of the, you know, the old cliches, the market climbs a wall of worry, and well, we're still worried, and we're still climbing.
I wonder what you think about the, you know, we talk about the fact that this is a liquidity-driven rally a lot. The carry trade, obviously, is the hot topic across the financial news sector over the last couple of weeks. Is that worrisome to you? I mean, do you feel like if that trade tips over, we could be in trouble?
I think it's possible, but I don't think it's going to tip over. There's so much liquidity there that until the Fed starts to dry it up, I don't see an end to it. That doesn't mean, you know, we couldn't get a correction finally or a setback, but I think the trend is still upward.
You know, I'm also curious, you know, Jim, we've had, it's interesting, over the last week or so, all of a sudden we have some deal flow. Obviously, one of the big ones was Hewlett-Packard and 3Com, but you had GE selling its security unit to United Technologies and a few other deals. That's a good sign. That's what you want to see in an improving kind of fundamental market environment.
Right, and that says that strategic buyers are stepping in, and they've got that have money are stepping in. Or you know, Cisco's on a shopping spree. We own some Tandberg that they're trying to buy. This is a healthy step that says that, you know, the good companies are looking for other good companies to buy.
Let's get back to our guest, Jim Moffett, manager of $5 billion worth of international assets for Scout Investment Advisors. His funds, by the way, are outperforming peers for the past 3 months. So, Jim, let me ask you, how closely do you watch what's going on in China in terms of economic growth and just kind of what they're doing?
Well, we're not short-term traders. That's not our style. But we watch China. We think that China it's a bipolar world. They make it and we buy it, but they're the half that's at this point driving growth in the world, and that's helping their neighbors. That's helping the raw materials. That's helping countries that sell raw materials like Australia and Brazil. So they're the big dog in the economy right now.
And that's why you like some of those raw materials companies, correct? Like a Vale?
Right, like Vale and POSCO, BHP that you just mentioned has been a long-term position. I mean, to us, that's, if you have to own one metal stock, BHP is the one-stop shop in that business.
You also like AmBev, obviously the big beverage company, and that's a play on what?
Well, this is just a play on Brazilian prosperity, and it's just a great, well-run company that keeps selling more and more beer. I mean, you know, you get hot and thirsty on the equator.